David, hasn't been that long since we spoke, but yet so many things have happened. And I was actually listening to your interview, your update last week in regards to Syria, and I was having this conversation with somebody personally in regards to what's happening in the world. And you look at over the last, I don't know, what, 2.5 weeks, give or take. You got Syria, you had South Korea declare martial law for like a minute, which I still didn't understand that one. You know, the attempted coup on the president declares martial law, and then next thing you know, it's over. You have what's going on in Georgia, the unrest in Georgia. You have France, they deliver no confidence. Germany just delivered a no confidence. And then I was just reading before we got on here that the UK might be next.
Yeah, and you've got Canada not far behind, with Trudeau, I think he's just below 20% in terms of popularity. There's whether it's Macron, Schultz, Trudeau, they're all like 20% approval rating. I mean, this is I think a lot of it has to do with what we saw in the election here, where the man in the street is like, you keep on giving me these statistics that say, life is great, never been better, and yet I can't pay my bills. So to hell with you. I mean, it was kind of like a referendum on BS, and I think you're seeing it globally because inflation has been an issue globally, and there's a lot of hardworking folks around the globe who are between a rock and a hard place, and then there's folks that have no problem at all paying bills or fine dining or whatever. But it's the divide is definitely greater and the people are speaking.
Isn't it amazing, though, in all the years that you've been doing this, that these events are just happening simultaneously in such a short amount of time? That's what I'm blown away by. I mean, do you feel that?
Yeah, it reminds me of the Arab Spring. Where you've got status quo in half a dozen countries, and then overnight it's like, nope, they're all gone. It's a different landscape, totally different landscape. So Syria's issues last week, I think, were pretty compelling because it spoke to both the inability of the Chinese to do anything. And it was only a year ago that Xi Jinping is whining and dining the Assad family in China, a 6-day tour, and basically says, "I'll do what I can. I'll do anything to keep stability in your country." Well, really, are you able? Why not? And the same with Russia, where Russia's been manning their aerial defenses and missile defense systems, and there's nothing. I think it speaks to, at least in the Russians' case, they're stretched too thin.
Yeah, the Syria thing is as we've had a little bit of time to digest it. I was talking to somebody about it, and this person brought up some interesting things because I mean, this war to get rid of Assad has been going on since the Arab Spring, which is amazing. And I used to say, the guy's like a cat. Like you think he's on the brink, and he's still there. Kind of reminded me of the end of the movie Scarface. Although he did, you had the hit squad, and he even didn't have the gun in his hand anymore. He was all coked up, and they're still shooting at him, and he wouldn't go down. But they couldn't get rid of him. And then all of a sudden, they just marched right in, and it was almost like the Syrian army. There was no defense. They just went through with ease. And you wonder, did Russia say, well, the hell with it, we'll throw our hand in on this one and just reallocate our resources back to focus on Ukraine? It's just very
Well,
weird.
the unintended issues that stem from October 7th, and you've got Palestinian issue and in Gaza, and all of a sudden Hezbollah is under pressure because Israel's going after both Hamas and Hezbollah. So Hezbollah can't fill the gaps. For Syria, they can't be sort of the proxy fighters for Iran. Iran would normally have supported Syria in that respect. Russia would have normally supported, but you've got all of these dominoes that are falling, and all of a sudden it's a window of opportunity for change. And it is that classic quote, there's decades where nothing happens, and there's days where decades happen, and that's boom, done.
So what does this mean to you now? Were you seeing these countries fall, right? Their government's collapsing. So if Canada is next, which to your point, I mean, Trudeau's talking about resigning before the election. What does that mean in the grand scheme of things? And then what is what is that? How will that impact the United States?
Well, I think it's a larger theme that's been in play since the global financial crisis. And, we had this strong push towards globalization, free trade, and, getting along. And as long as the economic pie is growing, everybody's happy with their slice. Now, all of a sudden, we've got some version of deglobalization, onshoring, friendshoring. The pie is shrinking to some degree. Everybody wants to maintain their same slice, and nobody cares about, you know, international relations the way they did previously. Maybe they care, but they're, focused on other things, focused on their constituents. So, yeah, I think it's consistent with a period of deglobalization. And I think, one of the key conclusions coming out of um, the success side, the benefit side of deglobalization, or of globalization rather, is that you're going to have more inflation. All you're doing is creating financial frictions, increasing financial costs, and the consumer is going to pay for that. So if we thought this is going to slow down, it can't. Deglobalization definitely speeds things up. Um, there's a Yale scholar, his name will come to me in a minute, Harold James, and he wrote about this in 2008, a book called The End of Globalization, and a pretty important book. But he's charting it even then and saying, yeah, this is what we're beginning to see. This is what we will see, and it is all about economic frictions increasing on the other side of the chapter of globalization being closed.
So where is this sitting then? Because I'm not familiar with that book. Where is this sitting at? Where things are at today? Where is that on the trajectory of where the book says we're going?
Conflict could be economic only, but these kinds of discussions that are being bandied around, particularly as it relates to Trump. Tariffs are one version of conflict, and if tariffs get bad enough, then you can have sort of a breakdown of the, what do they like to call it, the liberal order, and all of a sudden, Cold War becomes hot war. I think that's where James would say history is pretty clear. When countries start paying attention to their constituencies and are not focused on, you know building a better globalized world, there's all kinds of controversy related to that. But you know, all of a sudden, the opportunity for conflict, hot war, increases significantly.
And we touched on that in our last conversation. But do you think things are intensifying to that? Because it looks like that way to me. The way you're seeing these dominoes fall.
Sure. Yeah. I mean, the place we haven't seen it yet, is in the South China Sea. But even last week, the tradition has been, if the Chinese are going to run 100 boats around Taiwan and all over, around South Korea and Japan, which they're doing now, they kind of pre-announce, like, this is where we'll be, this is what we're doing. Last week they were silent. They did the same thing, but they were silent. That's significant. That's ominous. So, we're at a place where, when you combine economic desperation and geopolitical tension, I think you should be prepared for just about anything to happen.
The I don't know why the China aspect, and maybe it's just me being naive or just not having enough information, but in China's past, they don't invade, right? They don't put boots on the ground. So does the Taiwan concern you? Because when you look at their track record, like similar to what they did in Hong Kong, they just slowly put you in a submission hold without ever having to fire a shot. And then if you're any opposition, journalists, whatnot, they just remove you.
Yeah, I think, they've become more outward focused in the last 10 to 20 years. And you can see it in, the development of their naval capacities, and, things that weren't the case 20 years ago very much are the case now. So I think it's still more a regional desire for influence or control, and influence. That was originally the One Belt, One Road initiative. Create as many economic ties as you can throughout Africa and the Caribbean and South America and throughout Asia. And then, you just call in your favors. We helped fund this. We built that port. What about your roads? We still have the contracts for them. And they, that submission hold, that of course that's the case. But I think enough countries have figured out they really don't want to be under the thumb of the Chinese, and the Chinese have had to pivot a bit, not just economic ties, but again towards a more robust um, military apparatus. I still don't think they have much capacity beyond sort of regional influence, but Taiwan's interesting. Taiwan, you know, the globe has a dependence on products that come almost exclusively from Taiwan or come out of Taiwan at such a scale that we can't do without them. The IMF and World Bank last year, one of them penciled out 5 trillion as the cost to Taiwan being offline. I think the other was 10 trillion, which would be, combined far worse than the global financial crisis and COVID combined in terms of its negative impact to global GDP. I think there's enough at stake with Taiwan for the Chinese to move and for the world to do nothing because we have to have the chips because Taiwan Semiconductors, feeds NVIDIA and because NVIDIA feeds the world of tomorrow with all of the, functional chips that we need for AI and all the things that we're so exuberant about today. It wouldn't surprise me to see us say, well, we're really unhappy about this and just do nothing.
Meaning the United States wouldn't even respond. They'd let China just walk in.
Correct.
We wouldn't have the resources to do anything at this point either, though, right?
Yeah, I mean, the question of resources is certainly one thing. But the questions of the will, I think, is the other. Because you can scramble resources in the context of war. World War I and World War II, you could argue we didn't have the resources to do it. And we just reshuffled and reorganized our society towards becoming, manufacturing giants. And we funded the war and, reallocated assets towards that effort. And, the economy became a war economy. So we could get there if we wanted to. I just don't think we have the will for it. And I think we have an idea of the good life and sort of status quo. I don't. You look at how we've treated friends in the past, and if it doesn't cost us much, we're all in. If it costs us something, maybe we're in. If it costs us a lot, we're probably out. And in this case, I think it's better to look the other way and just know that, Taiwan Semiconductors is going to continue producing chips. It's just going to be with a different CEO.
And the United States doesn't matter to us where we're buying them from, right? We're still going to buy them.
Way too pragmatic. Gone are the ideas of, loyalty, connection. Yeah, I mean, we'll do what's best for us.
And I feel like the people in Taiwan is it you want is it divided to where some of them would like to be connected back with China anyway.
Certainly it's a generational thing. I mean, if you go to South Korea, there's a generation of South Koreans who was MacArthur. I mean, there's no recall because it just hasn't been important. Whereas you talk to an older generation, and GI Joe, man, yeah, there is a deep gratitude, right? So there's been information loss as the generations have passed, and I think that's probably the case in Taiwan as well. And frankly, I mean, there's if you look at the history, Chiang Kai-shek was while he was an anti-communist, he wasn't the greatest guy. He took care of the military and made sure that they had enough resources, and then that did cost a lot of lives, local lives. It just you got to choose if you're going to survive, and he chose survival of the military complex over his people. So yeah, I'm sure there's some in Taiwan that would look and say that wasn't our choice, and we paid a price for it, and it's all kind of unnecessary. And um, I mean, I don't know any Chinese that don't think that Taiwan belongs to them, and I don't know any Taiwanese that believe that they belong to China. So there is still a divide. There is a divide, but um, thinking that there's some sort of deep loyalty to their history, I think you could probably find a little bit of a divide amongst the Taiwanese.
Is this in your estimation China's priority is Taiwan now versus Japan or the Philippines or
I think so. Yeah, I think so. And when you combine the financial state that they're in, which their credit numbers out this week would suggest that they're still between a rock and a hard place. Even, we had October numbers in real estate seemed to be picking up, transactions were picking up, economic activity was picking up, retail sales were picking up, and November's numbers were ugly, way below expectations. They need to bring out the big guns from a fiscal standpoint. They need to pull like a Mario Draghi will do whatever it takes. And they basically said as much last Monday, but the markets, without being given specifics, had reversed course by Tuesday, Wednesday, Thursday of last week. I mean, it was kind of a dud. And why they wouldn't give the announcement of specifics may very well relate to designs that they have on Taiwan and knowing they need to keep the bazookas, fiscally speaking, from an economic stimulus standpoint, still in reserve. Big announcements to come. But as things deteriorate in the economy, war is something that is sort of you reorient people's attention. You distract by something that is very focused on nationalism and identity, and Taiwan would be the perfect thing.
yeah, and it's hard to know what the truth is. Well, it's hard to know what the truth is whatever you read anymore. But in regards to China, because it's like you come back to Evergrande. Remember Evergrande? That was going to be the KO punch, KO punch, KO punch, and then they had tanks in front of the banks. People couldn't access their money. The office was locked. All this stuff, and yet it fell, and the country is still standing.
Yeah, it's still in shambles though. I mean, that whole space, I'll give you some statistics on the current yields for the other ones. Country Garden is an example. Current yields on their bonds, 579%. 579%. We think of high yield or junk as something, easing into the double digits, 12, 14%. Evergrande, 7,966%. That's the yield. Sunac, 175%. Lawn 4, 13,144. And that was 3,690%. I mean, this is the yield on their bonds, which basically says their equity is worth nothing. Kaiser, 759. Kind of the last man standing is Vanke or Wonky. I don't know how they pronounce it. 17.5%. They're the best run. But even 17.5% is a real burden for an operating company.
But yeah, they still keep this. They're still able to keep this thing together.
You know, I say this pragmatically. There's some advantages to a command and control economy. You get to decide in real time who the winners and losers are, regardless of how the people feel about it. And if the people want to protest, you just throw them in jail. I think that's terrible. Um, it does give them kind of a longer fuse. I think that's what it changes. It just gives them a longer fuse.
Well, and then so I'm going to go to China, then I'll go back to Syria here for in a second. But also, though, with China, I mean, they provide a lot of funding. I mean, in the Darien Gap, Panama, right? I mean, they're involved in that. I wonder how much their involvement is in Argentina and El Salvador. I mean, where are they getting their money from, David? Like, how are they able to experience this growth that they're having right now?
You mean the Chinese?
No, well, just El Salvador, Argentina. Are
Oh,
the Chinese providing any type of funding for those countries?
no, I think the spigot from China is fairly well turned off. We saw the big investment in, port projects and infrastructure 10 years ago, and I think that's tapered a lot. Um, there's still assets there. There's still influence. I mean, you see it with resources. You see it with companies all over Africa. Um, China is active, but I don't think the money is flowing. Argentina, I think you are beginning to see the benefits of a turnaround from Malay. And, he's got a different worldview altogether. I mean, this is a guy that, reads Murray Rothbard and von Mises, and, has an inkling that the free markets should be unleashed and that government bureaucracy should be held in check. And, it's hard medicine on the front end. So he didn't jump out of recession, depression, devaluation immediately, but it's beginning to stabilize quite a bit. So I think ultimately good ideas play out in the form of human flourishing, and there seems to be a path forward for Argentina, at least of the countries you mentioned.
And then, so jumping back in the Middle East, in regards to financial instability, or is Turkey? Turkey's involvement in Syria, and they're not very financial stable right now as well, from what I've been told. Can Erdogan hang on to power with his own issues within his own country?
Yeah, well, he came in when the Turkish stock market and the lira were at an absolute low. So he built some credibility by being the guy who just by happenstance came in at exactly the right time, where everything in the kitchen sink was thrown, and so he's had some benefit from that. He's also been very aggressive, not as aggressive as Bashar al-Assad, not that kind of mean and nasty, but he's had his own version of mean and nasty. Yeah, they've got ridiculous inflation rates, and I think what he has as an opportunity now is to play the role he's always wanted to play in the Middle East. If you look at sort of the removal of Saddam Hussein so many years ago by the U.S., we took equilibrium and created disequilibrium. And then all of a sudden, there's all of these powers regionally that are trying to figure out who's going to be top of the heap. Iran wants to lead the Islamic world. Saudi wants to lead the Islamic world. Turkey wants to lead the Islamic world. And there's a vying for power. Well, this just shifted dramatically. I mean, with Hezbollah being basically taken out of the picture because of Iran, because of Israel's bombardments, and you now have Iran basically held in check. They're not in the lead. They're not in the running to sort of be head of the caliphate, if you will. And I think Erdogan's aspirations are absolutely that. The resurgence of the great empire. Um, that may be in his head, and there may be monetary and fiscal issues which keep him from that or slow that process down. But the opportunity with Syria out of the way is huge, and you can see it. Israel's moved past the Golan Heights. Um, you know, the Kurds are getting crushed by the Turkish forces, and they're taking advantage of a once in a half century opportunity, and they will end up with more land. They will end up with more influence. I mean, of the in the Middle East, the two winners through all this are Israel to some degree, and Turkey, and it's just who's left standing.
Do you see one of them marching across Lebanon into Iran to further demonstrate that they are now the leader of that region?
I don't. I think that's a tall task, and they're resource constrained enough. I don't think that's an option. Iran still has a lot of military muscle. They have a lot of military muscle.
What happens then in Syria in regards to Turkey and Israel? They'll just divide it or parcel it up? Or at some
No,
point, do you think one will say to the other, get out of here?
yeah, no, nobody knows. I mean, there's everything's on the table from like a divided three or four state. It's not clear. I think we have to get further down the road. The end, this time next year, we'll have a lot more to say on that. I mean, it'll be clear the direction.
Where is your level of concern in regards to? I mean, we haven't even come back in the United States yet. See, I want to work. We start out and we'll work our way back in, David. Where is your level of concern right now on the international front? I mean, even wasn't that long ago that you and I talked. Is it higher now than a month and a half ago? The same?
Yeah, I mean, I think the geopolitical complexity is much greater than when we last spoke. And with that introducing unknowns, I think I'm surprised by the amount of calm that we have in the financial markets. Um, there should be a lot more hedging. There should be a lot more risk mitigation, and at least in the U.S. markets, there's really not a lot of concern, and yet geopolitics has always factored large into you know how liquidity is flowing and how people feel um, about the capital markets. So that's a surprise given how almost obvious the geopolitical threats are.
Why do you think that is?
Um, Well, I think there's so much liquidity here in the United States that we don't feel we have to worry about it at this point. And we had the Z1 report out this last week, and if you look at the amount of credit that's expanded just in the third quarter, it's on par with previous peak years. So in one quarter, we have as much credit coming into the markets. So that there's really no reason to be concerned because of liquidity abundance. And so, as long as that remains the case, people are pretty excited to speculate. We're not back to where we were, in the fall of 2021 with margin debt levels. That was 935 billion. Now we're 815. But if you look at who's buying, retail investors piling in, and insiders are exiting in mass. Buffett has already exited in the largest form and fashion that he's ever done, largest percentage cash holdings relative to his other holdings in the history of Berkshire Hathaway. And he would say, well, there's just nothing that interesting to buy. Is that what's happening with your insiders? Because right now it's between 90 and 99% of all corporate insider activity is liquidations, not purchases. They just can't find something to buy? No, I think they know full well that this is a time to get liquid, keep their options open, and you're even seeing them move to the exits altogether. We've got a 19% increase in CEO retirement this year, 1,800 CEOs, CFOs in the C-suite exiting their jobs altogether. These little signs and signals would suggest that the retail investor is very close to being in that position of holding the bag.
Isn't that how this movie usually ends? The retail investor is left holding the bag, and that's when the shoe drops.
Yeah, yeah, absolutely. And as soon as you've got your last buyer in, somebody begins to sell. And now you hope that there's a buyer on the other side. And where you see a cascade decline within asset prices is when you have no buyers on the other side. Dave Rosenberg, an analyst I read regularly, said something to that effect this last week. He's like, you don't understand. You've got your mutual funds and ETFs, which are down to basically no cash. You get any liquidations, and there's not enough money for redemptions. You'll see an instant reaction within the pricing of assets, and it's not clear that there's sufficient buyers on the other side. And I think that's supported by the Z1 numbers, where we had, as a percentage of GDP, this is relative to GDP, comparing household ownership of equities. We're at 170% of GDP, the highest number we've ever seen. We've never seen the public this invested in equities before. So, I mean, they're like all in, all in, while insiders are leaving, while Buffett has already left the room. It's a pretty fascinating setup.
I mean, David, I get an opportunity to speak to people like yourself that point these things out. But these retail investors, I mean, maybe more of them should be listening to you and I, or not me. They should be listening to you. I mean, how are they not seeing? They see what Warren Buffett's doing. So how are all these retail investors getting involved in this?
They see their friends making money, and the fear of missing out is so great. It doesn't matter the price that they're paying. They've checked their brains at the door. They're not asking the value question. You know, Apple trading at almost 40 times earnings. There's no value in that company. It's become an electronics company that sells gizmos and gadgets. That it's not a high growth business, and yet it's being priced like it's something that it's not. Doesn't matter. Investors want some of that. They want the gains. They look at the returns over the last few quarters and then just start projecting out forward. It's extrapolation. You extrapolate from the past into the future, and you just assume that it's always going to be that way, and you act accordingly. Retail investors do the same thing on the downside. You get to a market trough, and they've drawn this extrapolation trend again to nothingness, and you despair, and you see them sell out at the lows. So they always buy high and sell low, and that's some people derisively call them the lumpen investoriate, just the common man who doesn't know any better. But they hold on to this notion of hope that I will retire, I will have something for my kids, I will have some degree of comfort in my life, and I see these people making money. How can I say no to this? They're making money. I want some of that. So it's a different equation. It's very emotional. It's not mathematical. Nobody cares about ratios and statistics because it would be a buzzkill, and that's people absolutely want the growth at any cost. So, you know, does Apple go from 3.5 trillion market cap to 7 trillion? I mean, there's a lot of people betting that they will. They're just betting against Warren Buffett, which is pretty darn fascinating.
And based on what? What is dictating that value going up that much? I mean, their products haven't changed. When was the last time they came up with something revolutionary?
That's what I mean. I
Yeah.
mean, it's a stale old company. It doesn't have a growth profile.
Nice new shiny camera in the iPhone 17 or whatever, the next model that comes out.
Oh, the next camera is going to have like six cameras, and not even five. And we're going to charge you $300 more, but we apply hedonics, and it doesn't actually compute as a higher price because you're getting more for the product. Actually, the price went down.
The parallels of things kind of reminds me of the CDs, right? The CD changer, the 6 carousel, and then the next thing you know, you had the 40 in your car. You could hold up to what, 40 CDs? Like you need that while you're driving, but somebody had to have that.
Now we have Spotify.
Yeah, yeah. So is that also explain the Bitcoin craze right now as well?
Yeah, I mean, I think there's cross currents because you've got the old iteration of Bitcoin, which is pretty interesting. You know, money that's not driven by a central government, and the opportunity to transact like you would with cash in a way that's anonymous and free. Like there's a libertarian argument for Bitcoin and a number of cryptocurrencies, which is pretty interesting. But that's not what it is. People don't buy Starbucks coffee with their Bitcoin. People don't go to the grocery store and transact with their own private, non-governmental currency. First of all, governments don't want competition. Having a money monopoly is a very powerful tool, and giving that up ain't going to happen. I mean, if there is a digital currency that ultimately is introduced on a broad scale, it's controlled by the central bank. It's not controlled by private enterprise or anything like that, because you just don't give up the monopoly. Not ever. Not ever. How do you implement, fiscal policy? How do you implement monetary policy when you don't even control your own money? So that's kind of dead on arrival. What it's become is a vehicle for speculation. And you could look at past iterations of it and say there's money to be made. And I can't argue against that. Bitcoin could trade at $1 million a coin. And tulips at one point sold for 3 times the average single home in Amsterdam. Did that make a tulip worth 3 houses? Not exactly, but people were paying it, and people who bought it at the equivalent of 300,000 were happy to pay the equivalent of 1 million, thinking that it was going to go to 3 million. So it's one of those things where the market mania, I think, is very well supported by that liquidity dynamic we were talking about earlier. The more liquidity that's in the system, the easier it is for people to justify speculation and risk taking. The less liquidity that's in the system, the dynamic shifts, and it's a psychological shift where all of a sudden people aren't thinking, how do I make as much money as possible? It's where's the risk and how much money could I lose? And that is not in the mind of the investor today because of the amount of liquidity that's pumping through the system.
It reminds me, Bitcoin right now reminds me, and only because I've had people say to me, I'm making money. I'm here at a store right now and I'm making money on Bitcoin. I can just sit back and it's just, the money is just growing, 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 growing. You need to get in on this. You need to get in on this. And it reminds me when I first moved to Arizona and it was like everybody owned 3 houses and a condo. That's why it was so funny when I was watching. If you saw the movie The Big Short, and Steve Carell was trying to get information in Florida, and he was talking to the stripper, and she's like, "I have 5 houses and a condo." It was always a condo. There was always a condo that was attached to it, and I remember, you learn from these experiences and these moments. I remember moving here, and I was like, "Oh, how am I ever going to survive? Everybody's got houses. Everybody's got real estate." And here I am, just a regular guy working at a bank, owning nothing, and then you just see it all come crashing down, and that's to me what Bitcoin. Everybody's talking to me about Bitcoin right now, and I need to get on this train.
Yeah, and look, again, the price could 10x from here, because that's the nature of something that is limited in supply and has demand increasing. The issue is, when do you run out of buyers? Because the day you run out of buyers is the day the market's over. And you don't know that until that day comes. So, accessibility is one of those markers of a late stage. Giving an example, the condos, people want to buy single family homes, but are priced out of the market. So what do they buy? They buy what is accessible to them, the condo, right? So when condos are proliferating, you're kind of at the end of a real estate cycle, because everybody's been squeezed out. It's an affordability issue. So Wall Street's coming up with ways for people to own something without having to shell out 100 grand, or 5 grand, 6 grand, whatever cryptocurrency you're looking at, whether it's Ethereum or Monera or whatever. It's you create the products that allow the demand to continue, because you're already past the mature stage, and you've got to have accessibility to keep the foot traffic going. But you already know your late stage when accessibility is being sort of, now the common man can play. That's happening right now with private credit and private equity. You've got Blackstone, who's, they're in the process of creating a number of ETF products, exchange traded funds, where with the click of a mouse you can spend $40 and own a share of a private equity, group or investment, private credit as well. And you used to have to be a qualified investor with at least 100,000, 200,000, 500,000, a million, $10 million to invest. And it's been chunked down to, you and I can buy private equity and private credit. Accessibility is your signal that this is really late stage. It tells you nothing about when it flips and goes the other way. Late stage could last another 6 days, 6 months. I don't think 6 years, but it's pretty late stage.
And in private equity, if somebody like you and I could just buy in, is there a minimum amount they set, or are they just trying to milk every last dollar that they can?
And that's what I'm saying. Through the ETF products, now they're putting these complex structures for qualified investors that used to have very high minimums, and now basically anybody can buy it. You can buy it in a 401k. If you've got $50, you can play. $50, right? How's that for accessibility? What does that tell you?
And if that private equity goes away, your money's just gone.
Well, again, it's just markets. When you have the last buyer in, the bull market's over, prices begin to decline. When you have the last seller out, you've put in a floor, and now markets can appreciate. And so it's just about managing the flows of people. And who's the last buyer? Again, you're having to make it more common, to make it more accessible, to keep the people moving in that direction towards the asset class. And these are some what were reliable. They give you extra returns, for their quote unquote illiquidity. It was known as an illiquidity premium. Now all of a sudden it's a mismatch. First of all, you shouldn't have illiquid assets in a liquid structure. That itself is problematic. And you'd think we would have learned that back in 2008, 9. But this is the nature of the markets. You're right, burnt bandaged finger wobbling back to the flame.
It's amazing that the system has been able to hold together as long as it has. I mean, we just spent a few minutes talking about private equity. How much, look at even healthcare, how private equities, weasel their way into that. And and healthcare, you're seeing that collapse in real time.
There's no boundaries. There's no boundaries. They're interested in veterinary clinics. They're interested in dental clinics. Private equity is interested in cash flow. And lest we forget what that is, private equity is just the old leveraged buyout funds. It's the Michael Millikens rebranded, and instead of the double-breasted suits, they're wearing something else today. But leveraged buyouts, there's so much leverage attached to that game, and it requires cheap credit. And it's one of the reasons why private equity has kind of ground to a halt over the last 18 months. If the cost to borrow money goes up, you can't make your deals work. Classic strategy is gobble up a company, break it into pieces, and sell it for a higher multiple. You've leveraged it up, and you're out with cheaper money, even cheaper money coming on stream. So somebody looks at it and says, yeah, well, you borrowed at 5, I can borrow at 4. The next guy will borrow at 3. The multiples are going to go up. Everybody's making money. But when interest rates start to go up, that's the end of that cycle. And, here we are this week playing with, oh, rates are going to come down. Yeah, there's a 97% chance that, the Fed funds rate comes down 25 basis points. Who cares? That has nothing to do with what's happening in the bond market, where you're already beginning to see this sort of move away, the divergence from bond yields versus Fed funds. We were at 363 on the 10-year in September when the tightening cycle ended, and now things have loosened. Rates have come off 75 basis points, and yet the 10-year is 80 basis points higher, right? So they've done this. They're moving away from each other because the bond market says we don't like what we see. The bond market would imply that maybe inflation's not dead, and yet the Fed funds rate says, oh, no, we've got it under control. We're moving towards 2% inflation target. And, it's just, those are important disconnects, because if the cost of capital is rising over the next 2, 3, 4, 5 years, all of that private equity stuff is going to hell. It's going to hell.
What does that mean?
Think of a better way to say it.
What does that mean? It goes to hell.
So if I've put together a fund, I've invested in these companies, and I'm assuming that I can exit on a 3 to 5 year basis on better terms. Now the terms are worse, but I've got to refinance my debt, and I have to do it at higher numbers. I can't keep the asset. So you're talking about, bankruptcies, distributing, assets that went from the public markets to the private markets, or, the private sort of gobble up. We talked about healthcare and veterinary clinics and dental clinics, all that stuff that's being gobbled up. Can they keep the asset if they can't afford it? Their assumption was we're going to flip it, make some money flipping it. But that assumed a lower interest rate environment, not a higher interest rate environment. So higher for longer is the death of private equity. Higher for longer is ultimately going to put a lot of pressure on private credit. Higher for longer is what takes the air out of the balloon, the bubble, which is in the public markets, your stock market.
And it is private equity. They've expanded to the point where not outside of healthcare. I mean, aren't they like bakeries and like plumbing type small businesses? I mean, there's no limits to what they will go after.
No limits. No limits. Just packaging cash flow.
So let's say for they have to unload ABC veterinary clinic and there's nobody to buy it. The original owner probably doesn't care, right? Because they've already received their money.
I hope the original owner comes back in and buys it for 10 cents on the dollar, and not only made money on the buyout, but now has the business back and is operating it like a small businessman was doing so well before. I mean, so this is not like, it's not an Armageddon scenario. It's just when you start misallocating capital, somebody has to lose. And that's where I think the average investor needs to look at the current environment we're in and say there's a massive misallocation of capital. And there's massive losses to be taken on that misallocated capital. Just don't get sucked up in it. So, having a healthy portfolio of short-term treasuries having a healthy portfolio of precious metals, you're basically creating a liquidity pocket that is somewhat inflation vulnerable in the treasuries, but inflation protected if you create a metals overlay. And you may find yourself in a position to either own publicly traded companies at a discount, or if you're an operator, previous owner, you may be back in the ownership slot.
And we didn't even touch on the fact that all the commercial real estate paper that's coming due in 25. I've read anywhere from $1 trillion to $1.5 trillion. How are they going to get out of that? These people are creative, though, David. I'll tell you. The chips are down. They find ways to just wiggle out of it.
Yeah, commercial real estate still under the gun in 2025. The U.S. government's under the gun. Depending on how you count it, somewhere between 7 and 9 trillion that has to be rolled over. And so average interest costs will go higher, which is why they've already penciled out interest as a line item being the largest budget line item for the 2025 budget. 1.2, 1.3 trillion. They'll spend more on interest payments than they will Social Security. They already blew past, the 860 billion for the military industrial complex, our defense spending.
But yet they still, the system still is standing and it has not been KO'd yet. What in your estimation could accelerate a collapse of the system? Because to me, they can just keep digitally moving things around, printing, whatever, and just keep it going. Keep the Ponzi going.
Well, I don't know that their options are as open as they used to be. When we had the global financial crisis, it was, if you look at sort of the progression of crises over the last 25 years, the first was specific to technology, one small little sector, and it had ramifications, certainly into the US markets, but not necessarily globally. Then, we lower interest rates, we create economic activity, stimulate growth, and this is sort of the Greenspan era leading to the mortgage finance bubble. And the mortgage finance bubble, because that paper was distributed all over the world, now all of a sudden you've got, banks in Britain failing. You've got pension funds all over the world who are saying, oh, I bought this stuff because it had an implied government guarantee. I didn't think I could lose any money. That was the mortgage finance bubble. We've come in and tried to fix the world post mortgage finance bubble, post GFC, global financial crisis, and basically you've had the bubble migrate towards government debt. And so this is like the granddaddy bubble of them all. It doesn't go anywhere from here. Like there is no sort of migrating the crisis and allowing it to shift to a stronger balance sheet. The government balance sheet is the biggest and the most capable of taking on those obligations. And so you think they can get out of it, but we've just had the bubble migrate to the heart of the system, money and credit, government credit. And that's where it gets really interesting. As long as central banks can maintain the public perception of their legitimacy, we go on. Full faith and credit of the fill in the blank. Maybe it's the ECB, the PBOC, the Bank of Japan. But if people still have faith in that credit, the game continues. To have problems in that space, now you've got systemic issues. That's where you could have, the next round to 8 or 9% inflation with a lot of egg on face for the Federal Reserve, not containing it, not controlling it, not guiding it back to 2%. And they didn't lose a fight. They lost their reputation. I mean, this is like, one more scandal in the Catholic Church. It's like done, right? And so it's when faith is gone, when trust is gone, it takes a long time to rebuild. It takes a long time to rebuild. So we've been able to migrate the faith to the next bigger, better balance sheet, and there is nothing bigger than government finance. So to me, this is sort of like this is where you begin to see the possibility of global inflation on a scale that you've only ever seen in isolated cases, country by country. So the Hungarians blow themselves up, financially speaking. The Germans blow themselves up. The hyperinflation 1919 and 1924. Like these are very specific cases. It's the Treaty of Versailles. It's the payment of debt. And you say, well, that's idiosyncratic. This is not idiosyncratic. This is uniform. This is universal. And a lot of it started after the global financial crisis when the liabilities were basically swept under the rug and assumed on government balance sheets. And we did not end it there. We didn't say, hey, privatized gains need to be privatized losses. You made the bet, you pay the piper. It was privatized gains become socialized losses. And that's where it just kept on shifting and it doesn't have anywhere to go. What are the answers? Debt jubilee. You can default on your debt. Those are certainly options, but you end up destroying the banking system. You end up destroying the economy in doing that. So if you push that button, it is like the financial nuclear option, but it's a global nuclear option. So strategy has to be inflate because you can make the burden of debt. You can take all the liabilities that are sitting on government balance sheets all over the world as they continue to grow, and you can make them irrelevant if you can pay them back with worthless fiat script. So the strategy is easy to implement. Very few people understand what inflation is, and it doesn't immediately compromise the financial system. It's just kind of a slow bleed. So, where we go over the next 3 to 5 to 7 years, I think is fraught with potential to become weird and on the inflation front, painful, very painful.
It's already weird, David. We got drones flying out over New Jersey. I mean, this is every day. There's something. It's
Something new. Balloons over Montana, drones over New Jersey.
president, closing his eyes at meetings with Biden. I mean, like it just.
We're in the financial twilight zone.
I know I'm running out of time here with you, but I did want to ask, just as we are at the end of the year, and with Christmas being next week, and the end of 24, what has it meant for you at McAlvany and your organization, and how's this year been?
Well, I mean, so we operate two separate businesses. One is an asset management company focused on hard assets. We broadly define that as, real estate, specialty real estate, although it's less than 3% of our portfolio today. Again, kind of goes back to the interest rate concerns that we have. But real estate is one segment, infrastructure is another, global natural resources a third, and precious metals mining companies are the fourth. That's where we've specialized, and we've had a phenomenal year. Returns have been healthy, clients have been happy, assets under management are growing, and I think we've got a solid thesis for the context that we're in and continue to move into. On the physical precious metal side, our second business, which is really our first, the one that started in 72, 53 years old, 54 years old now. It's been strong, but with the price of gold getting to 2,800, you might assume that that indicates a tremendous amount of traffic. I would put this in a top 10 year, but barely in a top 5 and nowhere close to a top 1, 2, or 3. And so in terms of sort of revenue into the space, a lot of the price action has been driven by central bank demand. And that has, put the gold price, in the public awareness, but people are far more interested in NVIDIA and Apple and, MicroStrategies, just whatever the hottest, how can I make as much money between now and this afternoon as possible? So, I think that we will see more growth with investors looking at their equity portfolios under pressure. We don't have that today. So this is sort of what I would see as pent-up demand, potentially in 2025. Central bank demand continues to be strong. And like the Chinese, for the month of November, they took about a 5, 6 month hiatus in purchases, or at least in announcing new purchases. 160,000 ounces brings them to over 79 million ounces as a store of value, as a reserve. And they took advantage of lower prices in November. I would be doing the same. If we get any weakness in price, which arguably should be there, we're in a seasonal weak period, typically happens between October and the end of January. That's one of two seasonal weak periods each year. If prices are lower, it's a time to be adding to your metals position. Silver, I think, could be the big winner in 2025. If I had to pick two commodities to sort of put an emphasis on, it'd probably be silver and copper. With silver being my preferred because it's less of an industrial, less tied to Chinese growth. We're responsible for 50% of global demand in terms of the copper market, and more oriented towards an inflationary outcome. People in the U.S. particularly get very twitchy about inflation, and they buy silver hand over fist. People are not concerned about inflation today. I think it's important to look back at the history of inflation and see that it always comes in two waves, certainly in the United States, maybe not globally. But if you were to chart inflation, the 1914 to 1919 period had a steep rise in inflation, and then it came back down. The secondary wave of inflation is always the bigger wave. Happened again during World War II. So late 1940s, you had a big climb in inflation, came back down, and then took off again. Surprised everybody on the upside. Same thing happened in the 70s, where you had an initial steep rise, came back to normal, and then took off. But we've had our initial, and I think the secondary is coming, and that I think will drive a tremendous amount of demand for silver in particular. So if I had to pick an asset to sort of underscore for 2025, probably be silver.
So you think the secondary wave of inflation is not far down the line?
I don't think it's far down the line at all. And there's reason to be concerned about the impact of tariffs and sort of that stimulating inflation. But I think you can look at a tremendous amount of inflation, again, just coming from the increase in frictions that come from deglobalization. So take tariffs. I mean, tariffs would be a part of that, but we've already got that deglobalization trend in place without sort of the tit for tat between countries trying to get a better deal for goods sold or goods imported. So, to me, the second wave of inflation, maybe it's a latter 2025. And I'm hoping that we see a significant correction in the metals over the next 60 days that allows people to sort of back up the truck. The factor here, and the reason why you can't completely bet on that, you can't look at charts and say this is what's going to happen, is because of all the geopolitical stuff swirling. You get so many issues where those two markets, gold and silver, can become very, very event driven. Just like oil it can take on sort of an emotional component given current events. That I think, flips the script very quickly for the gold and silver market into a positive uptrend. And so, if you don't own any, buy some at these prices and leg in, sort of dollar cost average into a lower price structure, but don't be counting on getting the ideal price. The ideal prices would be 2,400 and 2,200. A 10% correction off of the peak, a 20% correction off the peak, just for gold. Silver looks a little bit different, but you may not get those because we are this close to the markets becoming event driven. So you got to be somewhat pragmatic, somewhat philosophical about taking a position in the metals. But I think they are probably the best means of preserving value in the higher for longer and inflationary environment we have in the years ahead.
David, where can people find you?
Easiest place would be McAlvany.com. McAlvany.com gets you sort of into our universe of sort of educational resources. And, we have a vaulted program, which if you want a dollar cost average into the lowest price for, silver and gold in the market today, vaulted.com, or you can download it on your app, in the App Store. There's lots of ways to find us, but the easiest is McAlvany.com.
As always, thanks for taking time to speak with me. Have a great rest of your year. Happy New Year, Merry Christmas, and we'll see what beginning of 2025 looks like.
Thanks. Well, probably a little bit more crazy.
Well, and we say this. God only knows what will happen between now and even December 31st. Because it's like every day. I don't know about you. You wake up and you're like, what happened last night? What am I waking? I mean, do you do that? Like, what am I waking up to?
Oh yeah, no, I go to bed, pretty close to midnight every night, and I check the news to see if anything's happened in Asia and in Europe. And I'm up at 5 or 6 in the morning, and before I've even put my glasses on, I'll check the Financial Times and see if anything's missing. Is there a country that's just been obliterated, vaporized? I kind of like to know sooner than later. Um, it's an exciting time, particularly when you see so many investors on one side of the boat, because it means that there is not only a tremendous amount of money that will be lost, but there is going to be sort of a winnowing, and through that process, tremendous amount of opportunity emerge. So I think over the next 3 to 4 years, your best offense is a good defense, which is where metals factor in. We consider them to be sort of financial insurance. Um, Gold is the financial insurance. Silver is like financial insurance with a bit of like a steroid overlay. It's its own animal. But that to me, the best offense is a good defense in the next 24 months. And after that, I think the world's your oyster. The world may be chaotic, but that's that whole notion of buying when there's blood in the streets. Have you asked yourself the question why Buffett's sitting on $325 billion in cash? Why he sold out of his largest single position, not totally out of it, but mostly out of his Apple position? I mean, there is a time to get liquid, and there is a time to press a bet. And this is not the time to press a bet, right? This is a time to probably get more conservative in your equity positions, increase some cash, own some metals, and be patient. And on that basis, I think you're talking about building generational wealth.
David, until our next conversation.
Look forward to it.
Mic drop.